Everything in this business starts small, right? When I got started in real estate, I was a house flipper. And over time, things grow and you expand and you get larger, your capabilities become greater, and you grow a business. And then by virtue of having done that, opportunities open up. You come up with an idea and you execute it. And while to a certain extent that's true, the execution part is generally, it's an evolving process, and organic growth really can lead to a lot of success.
Yo, what is up, everybody? I am Matt Drouin. I'm the host of the Go Big Live Real Estate Investors Podcast, the show to listen to and watch if you are an experienced real estate investor that maybe owns a few single-family rentals, a couple duplexes, wondering what it takes to scale up into doing bigger deals. I am psyched out of my mind to have part 2 with episode 4 guest, Mr. Brian Burke, CEO and President of Praxis Capital. Brian has acquired over $800 million worth of real estate over a 30-year career, including over 4,000 multifamily units and more than 700 single-family homes. And with the assistance of proprietary software that he wrote himself, Brian has also subdivided land, built homes, constructed self-storage, but really prefers to reposition existing multifamily properties. And I brought Brian on because he is a fellow heretic like myself when it comes to going against the grain sometimes. And I want to bring him on the show to kind of talk about what's currently going on in the commercial real estate market. I am excited to have you back in the show, man. I appreciate it.
Yeah, you've come a long way since episode 4, so it's great to be back.
Absolutely. So let's dive into it, man. I mean, we were just talking in the green room. You peeled off about 3/4 of your portfolio, and in the wake of kind of what we've been seeing in the markets and the stress we've been having, in certain markets across the country. So, kind of like, what led you to that thesis? Because we haven't really talked about that in detail since we last talked.
Yeah, it was just a sense of irrational exuberance on behalf of buyers. And I first noticed this when we were trying to buy stuff in 2020 and early 21. We'd put in an offer and we wouldn't get the deal, and you talk to the broker and you're like, well, what happened? And they're like, oh, well, this one group came in, $5 million above everybody else and $1 million hard money and all this stuff. And I started to scratch my head and like, what are people thinking? And then when it happens again and then it happens again, you're like, that's it. If people really want real estate this bad, they should have all the real estate we have. Far be it for me to deny them the privilege of owning everything I own. Let's see what happens. So we just by chance around that time got an unsolicited offer on one of our properties. It was way above what it was worth. With a big non-refundable deposit, and we're like, we'll take it, go for it. So we did. And then we're like, well, let's try this with some of our other stuff. So we just started listing properties one after the other. And, we were getting 20, 30 offers, way over our, projected pricing, big earnest money deposits, hard at contract signing. And we just kept going until the music stopped. Eventually, in one transaction, the buyer had to cancel because they couldn't get their financing. We knew at that moment the light switch had flipped, and the market was on its way down. And fortunately for us, we'd sold off 3/4 of our 4,000 unit portfolio by the time we got to that point where that last deal failed to close escrow. And we knew at that point, all right, we're just going to have to hold the next market cycle peak. And the rest is kind of history. That was early to mid 2022 when that happened. And since then, multifamily asset values have fallen, by my estimation, somewhere between 20 and 40%, depending upon how I calculate it.
So I've been seeing the signs of stress, especially in the capital raising space, because I'm on the distribution list for a lot of people that are in the syndication space. And I'm just seeing for months and months and months, email title, like last call, to get in on this.
A few spots left.
Yeah, it's like a second to final last call, third to final last call. So it's definitely become a struggle out there. And speaking of capital raising, I was remiss in saying this. If you want to learn how Brian put together the financing for his first larger deal he did, he had to raise money from people with guns. And I'll leave it like that. So definitely make sure to tune back on that to hear his entire origin story. But going forward with this information, what should people be doing right now that are looking to be active in this space, I mean, we saw the writing on the wall and we actually started buying office because people hated office, and we were getting fantastic deals in that deal space. So, I mean, I guess like, what are you doing right now to keep active? Like, what are you preparing for? Like, what are you positioning yourself for going forward, and what do you see going forward?
Well, you must have an iron stomach to do office. Mine is maybe I don't know what's softer than iron, but yet stronger than paper. I'm not really sure. There's some element that must fit that bill. I'm somewhere in the middle. I don't have quite the iron stomach for office, but if you can make that work, this is an awesome time to, if on a basis play, just a pure basis play, to try something like that. So I've been basically doing nothing. We haven't bought any real estate outside a couple house flips in over 3 years, and that's been intentional. As I'm waiting for the market to trough out, because there's no sense in investing on the way down if I can invest at the bottom or even on the way up. I don't have to catch the bottom. Some people think like, well, you're going to miss the bottom. And it's like, no, when it starts to climb, it'll climb for a long time. There's plenty of time to bolt onto that bandwagon. I don't need to be the first guy. So the only thing that we've actually invested in the real estate space in the last 3 years has been real estate debt. And we've been buying bridge loans for, fix and flip single family, small balance multifamily, kind of mid-sized multifamily stuff, and that's been really good. It's been a timely investment because it's just a safer spot on the capital stack, and it's immediate cash flow. And those are the things that our investors have been looking for the last few years. We'll be shifting back into searching for more multifamily opportunities once the kind of bid-ask spread starts to narrow enough where we think we can get something. We're underwriting regularly, but we're just not so far finding that we're getting very close.
Well, I mean, this is interesting about the debt part of the stack, because that's oftentimes overlooked. I mean, where does somebody even go to find debt to purchase? And I'm assuming the thesis is to buy the debt at a discount to its unpaid principal balance, but tell me about that.
Yeah, that certainly is one thesis, especially in the non-performing loan space or for low interest rate loans. You want to buy them at a discount to increase your effective yield. That's not the business we're in. We're actually buying loans at par, but the loans that we're buying are 10.5% to 11.5% note rates, where we're actually getting a decent going in yield without having to buy at a discount. I wish I could answer your question about where you go to buy them. It'd be nice if there was an easy way to describe this. I got into this side of the business like kind of by happenstance. Several years ago, we started a loan origination company, and the model that we operated under was we would fund the loan and then we would sell the loan. And we had a bunch of institutional partners that were buying the loans from us. And after that business grew like larger than I ever would have imagined, even in my wildest dreams, somebody came along and had to have that company. In fact, right before the market started to tank, and we sold the company. And in conjunction with doing that, we worked out a system that I could flip the table and go to the other side, and they would continue to sell loans, but I would be one of their loan buyers. So I'm basically buying loans from my old company. So that's how I got into buying loans, and that's how I get a robust pipeline of loans to buy. If it hadn't been for that kind of sequence of events, I would be just as lost as any other loan buyer that's trying to figure out where to go source product. I had a built-in proprietary flow. So that made it easy for me. And, I always preach this about business. Business is kind of like, it's a little organic. You get yourself into businesses because you have an edge. You have some kind of an in. You have some kind of an advantage. And that's how you get successful in a line of business. It's a lot easier to do it that way than to go, oh, I think I'm going to I'm going to invent some product, right? You have no sense of what you're doing, and then you try to create it from the ground up. It's a lot harder to do it that way.
Yeah, it's the infrastructure part. I mean, and I'm so sad that what you did is not very duplicatable for many people out there.
I know. I wish it was. I wish I had actionable advice. I mean, the actionable advice that I could say is, everything in this business starts small, right? When I got started in real estate, I was a house flipper, and over time things grow and you expand and you get larger, your capabilities become greater, and you grow a business. And then by virtue of having done that, opportunities open up. And that's how this is. I mean, people think it's like, oh, you come up with an idea and you execute it. And while to a certain extent that's true, it's the execution part is generally, it's an evolving process, and organic growth really can lead to a lot of success. And so I know the advice isn't really actionable on how to go find debt, but I think hopefully it's actionable to say, like, get into some kind of business and you'll be surprised at the opportunities that come your way by having done so.
100%. So getting down to the actual, let's get a little techie here on when you are purchasing debt, for instance. What's kind of like the test of value that you use from like a loan to value kind of standpoint, where you believe wholeheartedly that you're going to be in a margin of safety when you're purchasing these things?
Yeah, this is it's an individualized decision on every deal, because you have to look at these just like you're evaluating a purchase. Like, when you're buying something, you have to think like, am I paying too much for this property, and am I going to be happy owning it for this price? Thinking about it from the debt perspective, you still have to think about the same way. Like, if I had to foreclose on this property for the amount of money we have in this debt, would I be okay owning it? The difference here, though, is that's not the first calculation you make. That's the second one. The first calculation you make is, how confident am I that this borrower is going to adhere to the terms of the loan and pay this loan off and make all the payments on time? Because that's really your goal. We're not a loan-to-own business, so we're not in this to try to see if we can get to the real estate. We want the loan to get paid off. We want all the interest. So you're looking at borrowers' FICO scores. You're looking at their track record as an investor. We don't loan to first-time flippers, or we don't buy loans that were originated to first-time flippers. I should put it that way. We want people with experience. We want borrowers that have cash reserves in the bank. We want borrowers that have a track record, and a track record in the market that they're in. So that's kind of the first thing that we look at holistically. Then we're looking at, what's the loan to value ratio? What's the loan to cost ratio? How much money did the borrower put into the project up front to close? How much money are we holding in a capital reserve account for the improvements that are going to be made? And how much security does that give us that those improvements are actually going to be seen through to the end? We have to take all of those different things into account. And then at the end of the day, if we did have to foreclose and we did end up owning this property, are we going to be okay with that?
Mm-hmm.
That's the process.
Excellent. Now, I'm just curious, because I had a gentleman named Ethan Gao on our podcast just recently, and we talked about the mechanism of being able to using loans as collateral within which to fund more loans. Are you doing any of that, or are you just kind of like cash in, cash out type of thing with your business model?
Yeah, we did that when we were originating. We would use a warehouse line to expand our capacity for origination, because this was a velocity of money business. It's like, when we would originate a loan and you fund it, it might take 2 to 3 weeks to get it sold and get the money back. So oftentimes, like the next day, we might put the loan on a warehouse line to borrow out, say 60% of that money back, so that we could fund another loan, and that sort of stuff. So we did that then. Right now, we're not doing it, and we're not doing it not because it's not a great model, because it really is. We're not doing it because the cost of capital right now just doesn't justify it. The warehouse loans are tied to SOFR. SOFR is really high right now, and so if your SOFR's at 5.5 and you got a 3.5% margin over SOFR to your warehouse lender, you're at 9%, and if you're loaning at 10 or 10.5, you've only got a 1 to 1.5% margin, and it's not really all that worth it. And plus, if you're giving your investors an 8% preferred return and you're borrowing on a warehouse line at 9, now your debt costs more than your equity and it's not accretive to the return. So, it has to be accretive to the return. So, when SOFR falls maybe 1.5%, and we can tighten up the spreads to, less than 3.5%, we probably will pull a warehouse line. And at that point, we'll limit our warehouse line on a 1-to-1 ratio, or we won't borrow. Think of it this way, more than like 50% of value. So if we have 50 million in loans, we wouldn't borrow more than 50 million. So then therefore it doubles our capacity. Whereas a lot of lenders, they might borrow 80 to 85% of their capital. And to me, that's just too high a leverage, and you put your equity at risk.
So switching gears here, where we're at in the cycle of things right now, and I appreciate the fact that you said, who knows if we'd be at the bottom or anything like that. One of my favorite eccentric economists, Woody Brock, said something that was really stuck with me, and it was, "You're always going to be wrong. The name of the game is to be less wrong and to be less wrong more often." So when are we going to start, what sort of metrics or macroeconomic type of things you're going to be looking for to indicate things are kind of like on that trajectory up towards at least normalization in our cycle?
Well, from just a pure data standpoint, I look at forecasted future rent growth. I'm looking at forecasted occupancy levels. I'm looking at absorption ratios with a construction to absorption ratio. In other words, how many units are getting built versus how many are getting leased. The markets that have suffered the most over the last couple of years happen to be the markets that were the best markets, the 2 years prior to that. And they became victims of their own success because the developers were like, hey, look at this market. This is a great place to be. Let's build 20,000 apartment units. And then it's like, okay, but there's only 8,000 tenants. So now it's going to take 2.5 years to get them all rented out. But once they get caught up, then it's going to be a lot different. So I'm looking to see, a slowdown in construction. We're already beginning to see that. So that's kind of the quantitative side. Then there's a more qualitative side where I'm looking for syndicators to say, I can't raise any money. I'm looking for existing owners to be facing foreclosure and loan maturities. I'm looking for brokers to say, I can't get deals done. I'm looking for sellers to capitulate and say that, gosh, I've been trying to hang on so that I could refi, but I can't refi, and now I can't afford a rate cap replacement, and the lender's not going to work with me anymore. I just have to cut my losses and run. I'm looking for those kinds of things. I'm looking for people to say they hate real estate because it's toxic. The more negativity that you can kind of seek out, then the closer you are to the bottom, in my opinion.
Well, negativity, right? Especially in this age. I mean, I'm a geriatric millennial, so I remember, getting there was a few different news sources, right? Now there's thousands of news sources, and they're all based upon algorithmic type of things, and and the more negative stuff you start reading, the more the algorithm's going to feed you negative stuff. So what type of where are the sources of information you go to kind of assess that and inform your decision making?
Well, some of it is just my own observations from being in the market, talking to people, talking to brokers, talking to lenders, talking to investors, because getting a sense of what they're thinking is, to me, being at the head of the news curve or being ahead of the news curve. Outside of that, I just look at things like real estate-centered news sources that deliver just information, not opinions about where real estate is going, but just information about what's happening. Occupancies are ticking up so many percentage points, or rent growth is turned from negative to positive, or, construction is down. That comes from a variety of sources. I mean, some of it comes from brokerage shops that put out market reports, which you kind of have to take with a grain of salt because they're trying to sell you real estate. But if you kind of can take what they're writing and couple that up with data that you find from Axiometrics, Yardi Matrix, RealPage, Globe Street. There's a CRE daily newsletter. There's the Real Deal. I mean, there's a bunch of different real estate centered news sources that, I don't make my opinion off of any one article. It's kind of I read a lot. I spend probably 2 hours a day at least reading real estate news. And when you take all of that information, you look for common threads, then you can kind of sort out what's really happening versus what just, some opinion that's trying to be thrust on you.
Absolutely. So let's talk about cash. I mean, about 12 months ago, I made the decision to get, 7 figures liquid by the time of 2024. Which I have, and I did it for a couple different reasons. I saw even the frothiness a little bit in our own market in Rochester, New York, not to the extent that you're seeing in these other markets. I mean, we're kind of like a steady Eddie market. And then secondly, I started realizing as we were growing our relationships with community banks that we started getting more scrutinized on our liquidity position. So I just did it from a strategic standpoint of like, okay, well, we got this thing asset rich, cash poor doesn't work anymore. So like, let's take some chips off the table. Let's do some strategic refis and rebalance that. So like, what are you doing with cash right now? Like, is it money market accounts? Is it like you tell me about it? You told me a little bit about the fixed income side through these bridge loans, but tell me more about that.
Yeah, investor money we're putting only into acquiring real estate loans. It's the only thing I've been raising money for the last 3 years. So that's where that's going. My own money market accounts. I mean, I'm getting 5.5% or something like that, like virtually risk free. Why wouldn't you? So that's been a big source. But I've also been investing in a lot of other alternatives. Some liquid, some less so. I've been looking at a lot of cash flow and dividend ETFs and mutual funds, kind of just down the retail road. I've been investing in a lot of publicly traded securities, just your average run-of-the-mill stocks. Of course, NVIDIA and all the other stuff that everybody's investing in, which has been pretty good to me. But also a variety of other alternatives that are outside of the real estate space, like pharmaceutical startups, biotech, inventing new drugs and that sort of stuff, agricultural, oil and gas. And some of those are speculative. Some of those are cash flow plays. But they all lack one common thing, and that's liquidity. So I'm trying to balance, kind of the non-liquid investments with liquid investments and trying to boost returns in a balanced way.
100%. So going forward, I wanted to ask you, like, which markets do you hate right now in terms of geographic locations for their risk?
Well, California has always got to be the top of the list, and probably most of New York sits right behind it. Even though I will say I own in Buffalo, your neighbor, but California is at the top of my hate list, and it's not even so much as like a bad investment climate as much as it's a bad regulatory climate. It's just not a place to put money. You can't trust that somebody's not going to attempt to take it from you or make life very difficult for you. And California has forgotten that, money is like water. It flows to where it's treated best. And they think that, well, if you live in California, you have to invest in California. So therefore we can do whatever we want and you're still going to put your money here. It's like, no, I'll take my money somewhere else. So California's at the top of that list. In terms of like what markets have not done well, is the same list of markets that we used to say were the very best places to be. Arizona, Texas, Georgia, and Florida have gotten clobbered with new inventory. And like Orlando was a great market to invest in. And now they've gone and they've built 25,000 units or something in Orlando. And it's like everywhere you turn, like when we went to BPCon, was in Orlando last year, right? You were there. And when you drive from the airport to the hotel, didn't you see cranes literally everywhere? Like not building a 20 unit building, but building like a 500 unit building. And it's just like, there's a lot of inventory. And so that's made it difficult in a lot of those markets, because not only are you facing higher borrowing costs, but now you have declining income because vacancies are creeping up, concessions are on the table, or you're going to lose people. Negative rent growth is a real thing. So a lot of those southeastern markets that used to be the darling of the industry have been really problematic. And oddly enough, the Midwestern states have kind of been the jewel of the country over the last 3 years. I was on a podcast a couple of years ago with a guy that was in Ohio, and he's like, so where do you think, you're going to have the most rent growth for the next couple of years? I'm like, your backyard. And I never would have imagined myself saying that, but this is a tortoise and the hare thing. I mean, in the long run, those Sun Belt markets are going to rebound and are going to be the rent growth leaders, I believe, over, a 5 to 10 year horizon. Now, over a 1 to 2 year, maybe not so much.
Let's talk about Florida for a second, because I've been battling with my in-laws about this, and they're saying, oh, there's all these like people moving down there, and and I'm like, yeah, but they're like your age, they're baby boomers, and by a lot of accounts, like we're going to be losing 2 million baby boomers a year due to death alone over the next 5 years. So like, where are these like geographic markets that have like gotten a lot of this net migration inflow from a demographic standpoint in that age bracket of like of baby boomers? Like, what's your take on that?
Well, first of all, your ROI on battling with your in-laws is probably never a very good investment bet, but that's kind of beside the point. The in-migration has been centered a lot on kind of Phoenix, Vegas on the western side, and on Orlando, Jacksonville, Tampa, Miami, basically all of the Florida markets on the eastern side. You've seen some spillover into the Carolinas on in-migration. I think, the Texas and Houston, Austin and San Antonio markets in Texas have gotten influence from both coasts. So you've got that going for you. And that's all great. And that contributed heavily to rent growth. And it will continue to do so. And it would have continued to do so if it didn't get faced with this headwind of having this glut of inventory, because all those very same markets are the ones that got all the inventory, and the inventory outpaced the flow of the net in migration. But I don't really think that the migratory patterns are going to shift dramatically. One thing I've learned after years of studying demographic shifts is they move like a battleship. They don't move quickly. They don't turn course on a dime. Not like an economic cycle that, you can go boom to bust and back to boom inside of, 6 months. A demographic cycle shift can play out for years. And I'll pick on Buffalo, New York. I mean, the population of Buffalo, New York rose for like 50 to 75 years, leveled off for like 25 years, and then started to decline for like 75 years. And that's a very slow, predictable kind of movement. I don't think that the migratory patterns that we've been seeing play out are all of a sudden going to discontinue or reverse. I think it's going to continue the way it has. Maybe to a little bit lesser extent, because I think COVID amplified things, and the whole work from home thing amplified those movements. But eventually there's not going to be inventory to absorb all that in-migration, and it's going to force upward pressure on rents, which I think is a great investment thesis if you're buying at a way lower basis, this year, next year, than you would have, say, 2 years ago, and yet you're going to get that rent growth come back if you're patient enough to wait for it.
Excellent. Brian, you've been generous with your time. We're going to wrap up in a second, but before you do so, what can we talk to our listeners or speak to our listeners that are looking to scale up in terms of actionable advice that they can do like today, this week, this month to take their real estate portfolio to the next level and get into the commercial space?
I think the first thing you got to do, people always ask, like, what comes first, the deal or the money? And gurus that teach you like these courses and will sell you a $10,000 course and a $30,000 mentoring program will tell you, go find a deal and then you'll get the money, and we'll even help you do it, right? I don't believe that this business works that way. If you go to the department store to go buy something, you don't pick up the items, put them in your shopping cart, go to the cash register, ring up your items, then go, okay, hang on a minute, I got to go find some money to pay for all these things, right? It doesn't work that way. You go in there with the money to buy whatever you're going to buy. So I think the best advice I can give somebody who's looking to scale into commercial now is go gather up your money. And I don't mean that in a literal sense, like go open up a bank account and start taking investment dollars from investors. What I mean is go build your network, get your investor base, recruit all of this support that you're going to need. Get some written collateral materials together on what your business plan is and how you're going to do it, so that you can build some loyalty and a following from an investor base. At that same time, build your operations team, figure out what are you going to need to find these properties, what are you going to need to buy these properties, and what are you going to need to manage these properties. Get those teams together, because when the cycle does kind of trough out and it's time to buy, when you get into that phase of your business, you're running 100 miles an hour with your hair on fire, and you don't really have a lot of time for all this tactics and strategy planning. Right now, you're not buying anything unless you're maybe half crazy or found a great deal. Take advantage of that while things are a little slower and build up those systems and those relationships so that when the time is right to pull the trigger, you're ready to go.
Yeah, relationships move at the speed of trust. And that is a slow process, it's not to be understated. So, Brian, thanks for coming on to part 2, man. I look forward to talking to you in the green room.
Sounds good.